Okay, I think we're good to go. So, good afternoon. My name is Paul Bodicher. I'm the Director of Media Relations at the Bank of Canada. Happy to be here in Winnipeg. I'll be moderating the press conference this afternoon. Senior Deputy Governor Rogers will be pleased to take questions for about 20 minutes today. We have a reporter here in the room, but several on the phone, so I'm going to want to make sure that we get every organization a chance to ask a question. So I think, as you heard, we'll be asking you to limit yourselves to one question only. Please wait. Martin will have a microphone for you. Just remind people on the phone, please to mute your line unless you're asking a question, and then to unmute unless you're asking a question, mute again when you're finished. You can do so by pressing *6 and unmute by pressing *6 again. Et comme toujours, libre à vous de poser vos questions de la langue officielle de votre choix. So we'll start here in the room and with Martin Castro, the Winnipeg Free Press. Go ahead, please.
Thanks. Ms. Rogers, hi. I'd like to ask for your maybe a little commentary on the labor market situation. And I wonder, as you and your colleagues were, originally sort of analyzing the, effects the pandemic is having on our economy, I wonder how or if the labor market sort of behavior has been at all surprising. The record low unemployment rates, the incessant calls by employers saying that they can't find the right workers. Was this part of the bank's thinking early on during the pandemic? And just wonder how surprising its behavior has been going forward.
I think I would characterize it as fairly surprising. I mean, the labor market's been incredibly tight, and it's staying tight even as we see the economy slowing a bit. So, I mean, the banks put a lot of effort into really understanding the labor market in a little more detail over the last couple of years. If you go back to some of our previous monetary policy reports, you'll see some sort of deep dives on the labor market. Throughout the pandemic, we were able to break the labor market down into sort of smaller parts to understand where we were seeing the impacts the greatest. And then as the labor market has recovered, we're able to again have a look at it sort of by segment. But I mean, to your question, yeah, it's surprisingly tight, and it's staying surprisingly tight.
Okay, we're going to go to the phone lines now. I'm going to start with Paul Vieira from the Wall Street Journal before Steve Scheer with Reuters. So, Paul, please go ahead.
Ms. Rogers, how much weakness in the Canadian dollar is the Bank of Canada willing to tolerate should Fed and Bank of Canada policy diverge?
Thanks, Paul, for the question. Well, I think, as you know, we don't target the Canadian dollar. The floating exchange rate is a key feature of our monetary policy framework. Certainly we will watch the Canadian dollar. If there is a depreciation of the dollar against other currencies, particularly the US dollar, US is one of our key trading partners. That could potentially feed through to some inflationary pressure as import costs go up for Canada. But that is information we would take into our forecast and factor it into our policy decisions. But the floating exchange rate is and will continue to be a key part of our monetary policy.
Thank you. We'll go now to Steve Scheer from Reuters.
Hello, Senior Deputy Governor. Thank you for taking our questions today. It's been a while since you did the NPR in January. Would you say that the bank or you are more or less confident that you won't have to raise rates again than you were in January?
Well, I mean, we're going to continue to look for evidence that our forecast is bearing on as we expect. We will update our forecast in April. And we'll take the data in at the time. Just as we said in January, there isn't a single data point, Steve, that's going to tell us whether things are going in the right direction or not. We're looking for an accumulation of evidence. We're looking for a variety of things that will reinforce our view that inflation is coming down, that the economy is cooling down, and supply and demand are coming back into balance.
Okay, next I've got David George Kosh from Bloomberg BNN. David, go ahead, please.
Hi, Deputy Governor. I was just wondering, given how the U.S. Fed has signaled their intent to possibly move rates higher for a longer period than was previously anticipated, I'm just wondering to get your thoughts on how that's going to impact Canada's economy, as well as making sure that Canada's inflation heads down to the 2% target that the bank has mandated to head.
Yeah, I mean, I think when it comes to the decisions that the Fed makes to U.S. monetary policy, we really need to look past the decision and understand really what the Fed is reacting to. Depending on what they're reacting to, it can have a different impact on the Canadian economy. If they're reacting to global inflationary pressures, it's very likely we're seeing those same global inflationary pressures in Canada. If their decisions are being driven by more domestic factors, that might not show up as much in Canada. As I said before, we run an independent monetary policy. We make monetary policy decisions in the interest of the Canadian economy. Certainly, as our major trading partner, the U.S. has an influence on our economy here. But the most important point I would make is our monetary policy is targeted for our economy.
Okay, next I've got Mark Rendell from the Globe and Mail on my list. Mark, please go ahead.
Hi, Senior Deputy Governor. I have a financial stability question for you. We're seeing, as rates have gone higher, a growing number of variable rate mortgage holders seeing an extension of their amortization period if they can't cover interest costs, having to watch the principal grow if they can't cover their interest costs. I'm wondering, at what point does that become a financial stability concern, and is that something that the bank is paying attention to?
Yeah, I mean, there's no question adjusting to the steep rise in interest rates has been challenging for Canadians, and in particular, Canadians who might have recently taken out a variable mortgage. And particularly if they were purchasing it sort of over that course of the spike in housing prices. So that is a segment of the economy that we watch closely. It's always important to keep in perspective the size of that segment. We've run through some of these numbers before, Mark. You know that there's the Canadian population sort of breaks down about a little more than a third are renters. The other 2/3 are homeowners. About half of them own their home outright. Half of them have a mortgage, and then of that segment, we're looking at a smaller percentage. It's grown a bit over the last year, the number that have a variable rate mortgage. But and then of that segment, there's people. Most variable rate mortgage holders have fixed payments. So it is true that we have seen with the increase in interest rates, that segment of the population reaching the point where they need to make adjustments in their payments. We're definitely watching that closely. As I said, though, it is important to keep those numbers in perspective.
Okay, thanks. I am now going to turn to Najoud Al-Malis from the Canadian Press. Najoud?
Hi, I wanted to ask about something you mentioned a couple times now, that what matters is why the Federal Reserve is deciding to raise rates further. I'm wondering, in your view, obviously you're not in the Fed, but I'm wondering in your view, what are some potential differences between what's happening in the U.S. and Canadian economies that might drive the Federal Reserve to raise rates higher than the Bank of Canada?
Well, I'm not going to make any comment about what the Federal Reserve might do. I can give you maybe a different way to come at your question. I can talk a little bit about some of the differences between what's going on in the U.S. economy and the Canadian economy. We are seeing inflationary pressures in Canada come down a little more than they're seeing in the U.S. There's also factors about the Canadian economy that are different than the U.S. economy. So again, I mean, I'd come back to the point I made earlier. You really need to look past just the decision that the Fed is making and understand really what's driving their decision. What are the things in their economy that are driving their decision, to really understand if and how that might affect the Canadian economy.
Okay, we're now going to go to Pedro da Costa from Market News. Pedro.
Thanks very much. Could you elaborate a little bit on what you might actually need to see concretely in order to reevaluate your view that that a rate pause is what's warranted right now? How much of a reversal in the inflation picture would you need to see for that to happen?
It's really difficult, Pedro, to give you sort of a single indicator. What we have been saying is we are looking at an accumulation of data, of evidence. We'll update our forecast in April, and that'll give you a sense of sort of how we see the economy evolving over the coming months, and in particular how we see inflation evolving over the coming months. And so we'll be looking at a number of factors. We'll be looking at the labor market. We'll be looking at inflation itself and inflation expectations. We'll be watching some of the global factors that have retreated. If they come back, that'll probably change the picture. So there just isn't. It's just too difficult for me to give you a single indicator. The key words are accumulation of evidence.
Okay, thanks. I've got 4 reporters left on my list. However, if anybody has joined the call late and wants to get into the queue, I just ask you to send a quick email to communications with an S at bankofcanada.ca, and we will do our best to get you in line. Next on my list is Stephanie Hughes from the Financial Post. Go ahead, please, Stephanie.
Good afternoon, Senior Deputy Governor, and thank you for taking our questions. Yesterday's statement noted that economic developments are moving in line with the central bank's outlook, and there wasn't a mention of excess demand. I understand it's still a concern for the central bank, but how much has that concern around excess demand eased? What's the progress rate hikes are making in this regard?
Sorry, Stephanie, I had trouble hearing you. You were cutting in and out. Can you maybe repeat that question? A bit slower too would be good.
I was looking at the lack of mention of excess demand. I understand it's still a concern for the central bank, but how much has that concern eased?
Yeah, well, I mean, I come back to our January forecast, and we estimated the output gap then to be between about 0.5 and 1. So, we did see demand we did see GDP come in a bit lower than expected, but if you kind of look under the hood on that number, it was mostly attributed to a reversal of inventory investment. So, our assessment, all things considered, is the economy is still in excess demand. So we still have a ways to go to get that balance we're looking for.
Okay, I'm going to go now to Craig Lord from Global News, please.
Hi, Senior Deputy Governor. Thank you for taking our questions. One of the things you said, I believe, in your speech today was that companies need to return to more normal pricing behaviors. Would you say that right now, are companies continuing to price according to a high inflation environment, even as we are seeing price pressures come down in some areas and the economy slowing?
I don't think we're quite back to normal yet. We are. What businesses are telling us in our surveys is they are slowing down the sort of frequency and the size of price adjustments they're making. So that is good news. But I think we do have a ways to go to get back to what we would call more normal conditions.
Okay, I've got Randy Thantong Knight from Bloomberg. Randy, please go ahead.
Hi, can you expand on how the bank views a reacceleration in economic activities in Canada's trading partners as creating inflationary pressures here?
Well, I mean, we're certainly looking for, central banks around the world are raising interest rates to respond to the same thing that we are. There's excess demand in the economies. We are looking for, we are expecting an overall slowing of global demand. That'll help bring the global inflationary pressures back into balance too. We have seen a slight uptick both in the U.S. and Europe and our key trading partners recently, but we'll update that when we publish our forecast in April.
Okay, and the last person I currently have is Dave Parkinson from the Globe. Dave, please go ahead.
Hi, Carolyn. I wanted to ask about the labor productivity concerns that the bank has. I mean, as you pointed out in your speech, the productivity numbers are kind of going in the wrong direction, especially to support the levels of wage increases that we're still seeing. I'm wondering if we can dig a layer deeper, and if you can tell me how the bank assesses why that is, why labor productivity has been falling, and by extent what that might mean for inflation in the labor market as things evolve.
Yeah, thanks for the question, Dave. I mean, labor productivity is one of those things that it's a little bit difficult right now to assess how much of that is a bit of a holdover from some of the effects of the pandemic. We talked a lot about this over the course of the pandemic, the number of things that businesses were contending with that were affecting their labor productivity. Certainly in a super tight labor market, if you're having trouble getting enough staff or enough qualified staff, that's going to affect productivity too. So, optimistically, we can think that some of the effects on productivity right now are temporary, and they'll work themselves through as we pull out of the pandemic. But as you know, and you wrote about, the productivity challenge has been with us here in Canada for quite a long time. So it's not new. What is new is that it's combining with an extremely tight labor market. So a combination of a really tight labor market and flat or declining productivity is a recipe for pressure on wages, which is what we're worried about, because that will make it difficult to get back to our 2% inflation target.
Okay, and that brings us to the end of the list. I would like to thank everybody for taking the time to dial in and ask questions. Martin, thanks for being here. I thank you all again for coming. Thank you, Senior Deputy Governor Rogers, and we will see you next time.